Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. In this video, I'll go through 25 rules of thumb in the investing and personal finance world, so buckle up. I will state the rule and give you a quick opinion about it. And so this is going to be a fun video, at least for me. 100 or 120 less your age is the percentage of your portfolio that should be in stock. The younger you are, the more stocks you should have in your portfolio. The previous version used 100 less age. So for example, if you're 30, you should have 70% of your portfolio in stocks and about 30% in bonds. Since you can take the stock volatility, as you theoretically don't need the money for a long time until you retire. Recently, the experts started thinking you should have more stock than previously, so now 120 less age is used. Another version is your age, less 10, as the percent of your portfolio that should be in safe investments, like bonds. The 4% rule drawdown rate, or conversely, that you need 20 to 25 times your annual expenses to retire. This is a rule of thumb that uses the 4% rule from the Trinity study, where a portfolio was run through representative stock market results for a retiree. The study arrived at a 4% withdrawal rate, where 4% of the assets could be used to live on each year without the retiree running out of money the large majority of the time prior to reaching the average life expectancy, leading to the 4% withdrawdown rule. An argument could be made that 3% would be safer today, since the study was done many years ago where bonds paid a higher interest than today and life expectancy was shorter. Also note that the assets need to be invested in the market, not in a savings account, since savings interest isn't enough to return for the rule to work. Assuming the 4% rule is acceptable, that indicates the retiree will have to have 25 times their annual spending needs saved in a retirement portfolio. This means that if the retiree is getting CPP and old age security during retirement and has a shortfall on a monthly basis of $1,000, they'll need to have 12 times 1,000 times 25, or 300,000 in their retirement account. Your term life insurance benefit should be about 10 times your salary and pay off your mortgage. So if you do need life insurance and you have financial dependence, the general guideline for life insurance amount to be insured is to pay off the mortgage, number one, and number two, for the amount of about 10 times the salary of the earner that's being insured. This will cover the family sufficiently, if invested, to live off of for many years with the lifestyle similar to what the salary provided. So for example, if the insured was making $40,000, insure their life for $400,000 and pay off the mortgage. 70 to 80% rule of spending in retirement. This rule of thumb is you can live on in retirement on 70 to 80% of what you lived off of when you were working. Since you don't have to save for retirement anymore, the mortgage is paid off, you don't need 2 cars, you don't need the gas, you don't need the nice clothes for office, and even your taxes may go down as you have less income, etc. Actual needs depend on what your plan is to live like. Whether you travel, you want to go out, you want to play golf, or just sit at home and read when you retire. Some people spend more when they're retired than when they were working because now they have lots of time to travel and golf. You should track your spending and make adjustments for when you're retired so you know how much money you'll actually need in retirement. Take stock of your planned in-retirement spending. Affluent retirees tend to spend much less than 80% of their working incomes on the average, whereas retirees with lower working incomes tend to consume a higher percentage of their working incomes in retirement. That's only logical, in that the affluent households likely had a heavier savings rate, whereas lower income households consume a bigger share of what they make. Rule of 72 for doubling of an asset. Divide 72 by the return rate in percent to know how long it will take for something returning that percentage annually to double. So 72 divided by 20 means an asset returning 20% will double in 3.6 years. By the way, aim to have your portfolio double about every 10 years. So that means you should be getting a 7.2 return on your portfolio. Rule of 1% for monthly rent. For a rental property, the rent needs to be 1% of the total property purchase price for the property to cash flow, roughly taking into account the mortgage and the various expenses. Save 10, 15, or 20% of your pre-tax income for retirement. Experts say you should save 10 to 20% of your gross income for retirement. More is better, obviously, and it depends on how you will be spending, what returns you get, what you invest in, and how much money are you making now in income. The 10, 5, 3% investment returns rule. This is a handy rule that states that you can expect a nominal return of 10% from equities, 5% return from bonds, and 3% return from highly liquid cash and cash-like accounts. The rule seems a little optimistic today, frankly, especially for the bonds and cash, but it was applicable a few years ago. 50, 30, 20% budget rule. You should budget 50% of your take-home pay for needs, 30% for wants, and 20% for savings. And please have a look above for my budgeting video. The 24-10 rule for car purchasing. When buying a car, you should put down at least 20%. You should finance the car for no more than 4 years and spend no more than 10% of your gross income on transportation costs. Dealers increase the lengths of the loans to make the monthly payments palatable and affordable, going to 7 or 8 year amortizations. The owner is immediately underwater with the car loan as the car depreciates. To sell the car, you need to put in extra cash, which the owner may not have, and so now they're stuck with the loan. Or the dealership leases the car instead to make it more affordable. But then there's no asset at the end of the lease as the customer has to return the vehicle or buy it. The first year salary rule for student loans. The rule is you shouldn't take out more in student loans than you expect to make in your first year on the job out of school. This is to keep the school loans reasonable for somebody just starting to work, and it's to make sure that you are getting a degree that is actually paying for itself. 3 to 6 months of emergency cash rule. Have 3 to 6 months of basic must-have expenses in cash as an emergency fund, and I've done a video about this previously, in case something happens, so you don't have to use a credit card to borrow or have to sell investments that could have just gone down. It's used for emergencies, such as when there's a problem with the car, as well if you've gotten laid off. And you should have an emergency fund before you start investing. Add your raise to your savings account. This rule is to prevent lifestyle creep when one gets a raise. Sometimes people, as they start making more money, improve their lifestyle and nice-to-haves become necessities. This rule of thumb says that if you were able to live off your previous paycheck, you should still be able to live on that amount when you get a raise, and you save the raise instead. When an appliance breaks, buy a new one if the appliance is 8 or more years old, or if the repair would cost more than half the replacement cost. This is from observations on how new appliance price compare to repair costs. Always take the employer match on your retirement account. The employer match is free money and a part of your compensation at work, just like salary, so you should always take the match. Please remember to make good choices about the investments you make through the employer account, both appropriate for your risk profile and invest in good mutual funds that you've researched. The financial advice in my experience on these accounts is minimal, so you need to pick the investments on your own. If the investments offered are good, you may wish to invest more than the amount needed to maximize the match, but make sure you are at least maximizing the match, even if the funds aren't the greatest. The retirement accounts at work tend to have high fees and high management expense ratio funds, but the employer may be subsidizing them. Save for retirement first and your kids' college expenses second. Parents want to help their kids go through college without having to work or borrow, but the kids have their whole lives to pay the loans off, and it is their education, and you need to look out for yourself. You have much less time before your retirement to save up for it, and once you can't or don't want to work anymore, there's no more money forthcoming. The kids can borrow for their college, but you can't borrow for your retirement. So make sure your retirement is safe and stable before you start helping the kids with their college. Buy a home that costs no more than 2.5 to 3 times your gross annual income. This will prevent you from buying more home than you can afford, and you should be spending no more than 30 to 32% of your gross annual income for mortgage expenses, which means the principal, interest, property taxes, heating costs, plus fees for condominium maintenance if that is what you are in. The rule of thumb will keep you within that range. To estimate the actual cost of owning a car over 5 years, double the price tag and divide that by 60. This is a general rule and subject to variation with the type and age of car and how far you drive it. This will allow you to budget for the car expenses. Don't spend more than 20% of your take-home pay on all costs for all vehicles that you own. This should limit how many vehicles you own. Since I don't have a vehicle myself, I would encourage you to limit your vehicles since the expenses as well as the depreciation are harmful to your financial health and wealth. Use insurance for catastrophic expenses, not basic ones. Have a high deductible. Some people think they will claim small things on their home and auto insurance, but that raises the cost of their future insurance, and so they end up paying out of pocket anyway. Having a high deductible makes the insurance much cheaper, and you keep paying for the small expenses out of pocket anyway. Home insurance and auto insurance is intended to protect you from total loss, not from small losses. The long-term inflation average is 4%. The Canadian Central Bank aims for 2% or a 1 to 3% range, but some people question how the CPI, the Consumer Price Index, is calculated and what it is included, and believe the actual inflation is much higher. Your income and net worth will be the average of the 5 people you spend the most time with. This indicates that you rub off on your friends and vice versa, and if you hang out with quote-unquote underperformers, you will become one. So choose your friends wisely, just like your mother wanted you to. If you can't pay for 5 of something, you can't afford 1 of something, from the minority mindset. A guideline for those of us who want to buy things they can't afford using their credit cards is that if you can't easily pay for 1 of something with cash, preferably, you shouldn't even buy 1, since your finances will be too stretched. You can either look rich or be rich. Very few of us live long enough to do both. Looking rich takes money. If you are actually rich, then it's fine to look rich. If you are poor and you are borrowing for and leasing items to allow you to present as rich, you're paying far more for these items than if you bought them outright. And it's just over time. Most rich people live comfortably without being showy about it, and thus save their money to remain rich. And I've done a video on how to become rich, and I mentioned some of these concepts there as well. Don't borrow to buy depreciating assets. I saved the best for last because this one is often misinterpreted, but it is a good guideline for other things. So you are not supposed to borrow for non-investments. It's okay, if you're comfortable with it, to borrow and use leverage for assets that are expected to go up in price, like a house or a mutual fund. But don't borrow to buy a car unless it's an Uber or a taxi, or a boat, which both go down in value, because you are then hit with the interest and with the depreciation, making your toy the worst financial decision ever. Some people will interpret the last point as a suggestion to lease the car instead, which can be even worse than borrowing to buy the car. You are still paying for the depreciation via the lease payments, and then you don't have the car after the lease is done. Well, I hope you're still with me and you enjoyed the 25 rules of thumb. Please put any rules of thumb that you like and use into the comment section. Also, if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.